Is it just owned jointly? Do we have the words et al, E-T-A-L on it? Boy, that's one of the scarier ones to me, because it may say John Jones et al. That means and others. Well, who are the others, and what percentage of ownership do they have? This is something you see often tied up in estates and properties that were a mess because maybe grandma and grandpa died and they left the property to their children. Well, some of the children died and their share then went to what would have been the grandchildren. Oh my gosh, we had a grandchild or two die and the great grandchildren have an interest. Et al. Can be an absolute nightmare, and tracking that down and trying to get titles cleaned up so that we can either sell the property or that we can distribute the property to anyone. Brings into a natural question of, well, I'll just avoid all this and I'll just name my kids as on the assets. I don't always think that that's the best thing to do. And let me tell you why. In my experience, when we're looking at assets that you hold gently with your children so you can avoid the probate process, in the event that your child gets divorced, that asset is in their name. In the event of a lawsuit, that asset is in their name. So let's think about that. You put your adult daughter on your home so that you wanted to avoid probate. Well, she's in a nasty lawsuit and she's getting divorced at the same time, and your house is listed as one of her assets for half of it. Yeah. We don't want to do that. You know, all your bank accounts that have cash and your CDs and all that stuff that you put them on as joint owner? Yeah, they have half of that. And technically, you should have filed gift tax returns if it was more than about $15,000 or $16,000, depends on when you're viewing this. That could be a whole different issue that had never been addressed. So should you own assets with your children? In many cases, I will tell you no during your lifetime, because the risk of you losing any of those assets that you need for your future, I don't think it's worth it when we've got other tools that we can take care of it and still not have the probate process if you don't want to. Now, what are some of the assets that you have with titles issues that you need to think about? Well, you could have raw land. You could have a business partnership. You could have investment accounts. What about bank accounts? How about cars? Do you have houses? Do you have retirement accounts? What about annuities? Do you have a timeshare? Do you have an art collection? I mean, there are so many different assets that you can have, and you want to treat each one of them individually so that you get the exact result that you want. And sometimes we use a couple of different tools in order to do that. In many cases, we can set the accounts up so that we have got a direct beneficiary on the accounts, so it avoids probate very easily. And the other thing that I will say about probate, you know, you got to pay to play in probate. Probate is not free. It is not free to anyone. So if you want to do the probate route, you are going to pay to play. Oh, wait a minute. You're not here. Your family is going to pay to play the probate game. And they really have very little control over how much they're going to pay, depending upon how the estate has been left and what the local jurisdiction requirements are. Let's talk about some hypothetical things. We understand that we are going to have to pay to play the probate game. Well, let's talk about some hypothetical expenses that we've got to have. Now, let's say that we have a house that is worth $300,000. It's just a number, pick an asset. If the probate fee runs somewhere between 3 to 7%, then that's $9,000 to $12,000 in potential attorney's costs in order to pass the house to whoever you want it to go to, after all of the debts have been paid that have been presented to the estate that were approved. Wow, that's a lot of money. Who's going to pay that amount? Now, if you had already set up a trust, well, you're going to pay to set up the trust, but we could pass the house and it would probably be a very nominal cost. You're looking at re-registering a property, very few things that may need to be done in that case. What if you did it through a transfer on death? Well, transfer on death is a way that we could do that. Some jurisdictions have a beneficiary title. It may be as easy as going to your Register of Deeds office, filling out a form and paying a $50 fee, and the issue is taken care of. Now, other things that we've got when we talk about we got to pay to play the probate game, I really do not want you to put any of your retirement accounts and have the estate as the beneficiary. There are so few situations that I can see that that's really the prudent thing to do versus naming a live person or the church or charity of your choice to receive it. Let's go back to if that money is paid into the estate. Let's say it's your retirement account as $200,000. The first thing that's going to happen is we have to include that on your income taxes. So that's going to put you in a pretty substantial bracket if it's on top of whatever other taxable proceeds you have. So we're going to lose a significant amount to income taxes. Now, if you live in a state with state income taxes, that's going to come off of the top. Remember our attorney? Maybe another, I don't know, 3 to 7% there. So that could be another $6,000 to $14,000. It doesn't make sense. And then that money, in addition, is subject to creditors' claims. So whatever is left when it's distributed to the beneficiaries, they can do anything they want with it. But you also gave up the ability for them to have tax deferral. So they would have an opportunity to choose when they might want to take some of these proceeds out in lump sums and to time the taxation of it. You take all of that away when you have the proceeds paid into the estate. Now, the other thing that we're looking at is, you may have non-taxable assets. Why pay them into the estate when, again, they're going to be subject to creditor claims, attorney's expenses, any estate expenses that we might have? It's so much easier to do a transfer on death or a pay on death if we don't need the money in the estate, or maybe we only allow one account to go into the state to pay for some of these. Let's not increase the bill. All right, think about those assets you have in the bank. What if we had $100,000 in checking, savings, CDs, whatever, and we pay it into the estate? Remember those attorney's expenses at a minimum? There's $3,000 to $7,000 plus whatever we might have to pay out of them. And how long is it going to take to get them? If we did a POD at the bank, guess what? They could have that money at no time at all. If we did it through the trust, again, a much quicker mechanism that's going to be available. Same thing will apply with mutual funds. What if you have vacant land? I mean, there are ways that we can pass these assets and not have so much lost. When we think about death and we think about inheritances, we are looking at the transfer of wealth. That's what we're doing. We're transferring the wealth that we did not spend in our lifetime. I love attorneys. They do fabulous things for us. I love appraisers. I love the different individuals because they make our lives easier and they fulfill a very valuable service to us. But when you're talking about your estate, is it your desire to transfer your wealth to the heirs and beneficiaries or charities of your choosing? Or is it your intention to transfer your wealth to a bunch of paid professionals? You really have a choice on where that pay to play is going to be allocated based on what your choices are. Enough said. Are you getting this? Are you hearing me? The other thing I would say is that when you're planning your estate, let's look at reality. Can we decrease the amount of pain and stress and time periods and meetings and notices and everything that has to happen with settling an estate because we put some things in place to streamline it, to make it easier, to make it workable, to make it cost less? Absolutely. But you've got to do some of that planning in advance. And it's not that hard. You get a couple of qualified advisors, you get an attorney, you might have your tax person involved in that too, and we can streamline the process. You'll have a nominal investment going into it, and it could reap enormous dividends in expenses and time when you pass to the beneficiaries who are going to be left to deal with it. Now, when you talk about increasing the value of your estate through planning, well, that is a whole different area. We just had been talking more about preserving the estate and trying to keep as little as possible from being liquidated out of the estate before it passes the heirs. But some of you may have a desire to increase the value of the estate through planning. And we can do that. In some cases, we're going to use living trusts. We might have houses and land in it, for example. We may have an irrevocable life insurance trust that we could use. What about other revocable or irrevocable trusts that we have investments in? Do you have a living will? Well, what about a power of attorney? Do you have a business power of attorney? Do you have a medical power of attorney? Now, Amy, how are those going to increase the value of my estate? By having these documents in place and having someone with the ability to go in and act. They could save investments or they could liquidate investments that were declining in value because they have the authority to do that. They may have the authority to complete a sale transaction on a piece of property that you were in the midst of. They have the ability to step in and direct care that you may need. That, of course, we all know medical care is not free either. So we can grow the value of the estate by using trusts. We can grow it by using life insurance, irrevocable life insurance trusts, other things in a variety of ways. We can also look at taking some of the assets and they are being actively managed if you're unable to do that prior to death. And then after death, we want to make sure the mechanism in place. Now, there's one other thing you could do. You got too much money, or you just want to help another individual, whoever that may be. Usually it's within families. You could transfer some of your investments, or you could transfer cash to anybody you'd like. And you can do that, again, depending upon when you're watching this, $15,000 to $16,000 a year. You want to check and see what that number is. And you can give it to them, and it's absolutely tax-free to the recipient. It has no positive or negative consequences to you on your own tax return. My husband and I would be a good example. I could give my daughter $15,000 a year. My husband could give her $15,000 a year because we are separate individuals giving her that money. Now, in addition to that, I may choose to give my son-in-law $15,000. My husband may choose to give my son-in-law $15,000. So we have each given only $15,000, and we have made this, but I have been able to move $60,000 of proceeds into my daughter's household. If I took it a little bit further, I could give $15,000 to a granddaughter. My husband could do the same thing. So with the right mechanisms and the correct way of distributing assets prior to death, we can do gifting programs to transfer the wealth into someone else's name, eliminate any gift tax liabilities, and accomplish whatever our heart's desire was at that point. And this can go to anyone. I am not in that position, but if I chose to, I could go down to the local store, grocery store, and make myself a little place out front and decide that every person who walks in today who has on sandals, I'm going to give them $15,000. And I could do that, and it would be tax-free to all of those people. It would have no consequence to me tax-wise, and there would be an awful lot of happy people who were wearing sandals, and my guess is they'd call all their relatives to come wear sandals and run down to the store. Now, I'm going to go through just a couple of questions here. I want you to think about this. Can I control dispersal of my assets from the grave for years without the need for a trust? Let me say it again. Can I control the dispersal of my assets from the grave for years without a need for a trust? Now, do you think that's true or false? Kind of eerie to think of, isn't it? The answer is absolutely yes. Some of you, if there was a concern that you had that someone would spend the money too quickly, we can use a spendthrift trust that would limit the amount of money they can get each year. We could also use annuity contracts, and we could elect that the beneficiaries have to take that money out over a period of years or their lifetime. It's a tool. It's a piece of paper. What are you trying to accomplish? We just want to use the right tool in order to do that. The other thing then when it comes to control is per capita. So let's talk a little bit about per capita. And I really recommend people put this behind the beneficiary's name. Every beneficiary, I want you to choose per capita or per stirpes. So here's how per capita works. I have 4 children that I have named as my beneficiaries, and I just happen to treat them equal on their percentages. I have put per capita behind each one of their names. Now, this child passes away prior to my death, and I did not update the beneficiaries. Per capita means that each one of these 3 children is going to receive their 25% share because they are still living. This child that predeceased me was not alive to receive their distribution, and so their share was divided equally between the other 3 survivors. Now that is per capita. So let's talk about per stirpes. I have the same 4 children. I have the same scenario. 1 child passed away prior to my death. These 3 beneficiaries were living, so they received their 25% portion. But the 25% portion that was allocated to my deceased child, they happened to have 2 beautiful grandchildren. Their share was divided equally between their living children, which was 2. And so that share went to my grandchildren. Per stirpes can be very effective if you do not want to inadvertently disinherit grandchildren because their parent was deceased. Now, the other thing that is really convenient about the per stirpes and per capita, going back to the 4, I do not have to treat every beneficiary equally. So if I want this one to be per stirpes and this one to be per capita and per stirpes, or any combination that I want, I'm handling each beneficiary individually. Can I change this? Anytime I want to update a beneficiary up until the point of death or the account is liquidated, you would have the ability to do that. And I know you may not think about it, and I'm guessing that 99.9% of you do not have per capita or per stirpes behind individuals' names. This is new to you. You don't remember, but in those reams and reams of papers that you signed, somewhere in the default language, if you listed a beneficiary, it will say whether they're going to distribute it per capita or per stirpes. It may or may not be what you want. So what you need to do is you need to update those primary and those contingent beneficiaries, and I want you to put per capita, and I want you to put per stirpes behind them, whatever is your heart's desire. Okay? Now, let's go back and let's start looking at this just a little bit more, and let's talk about the life insurance, because I touched on it very briefly. Most people see life insurance as only being, well, life insurance. If you're working for an employer, you might have a group life benefit. If you do it individually, you buy the policy on your own. But with life insurance, there's a variety of things that we can do with it. There are policies that are out there now that will provide life insurance benefits. But in addition to that, you can use what are called long-term care alternative riders. Not every company offers them. Not every company has them in their portfolio. However, with a long-term care alternative rider, then when you qualify for benefits, usually after about 6 months, then those portion of the policy proceeds could be paid out to pay for your long-term or in-home care. And when that happens, then that's going to reduce the face amount of the policy. But let me tell you why I like this particular idea. We have a life insurance policy. And one of 3 things is going to happen. If I have a long-term care policy and I never have a long-term care claim, all of the premiums that I paid, they're generally not refundable. And so that money is just gone. Just like, if I pay for car insurance or health insurance and I never have a wreck or I don't go to the hospital, I don't get my premiums back because I was covered during that time. If we look at a life insurance contract and we put long-term care as a part of a rider, we pay extra for it because we want that. Let's pretend, because it's a number, that I have a $500,000 life insurance policy. On that $500,000 life insurance policy, if I pass away, my beneficiaries are going to receive $500,000. However, I have split that percentage up. Very simple. What's another scenario? The scenario, if I have this long-term rider on the policy, I have that $500,000 face amount. And let's say that the premiums are paid and the policy states that if I have a qualifying chronic illness or long-term care type issue where I cannot do at least 2 activities of adult daily living, then they will pay 2% of the face amount, which 500,000 times 2% is $10,000 a month, that can be used in any way I see fit to pay for my care or bring in caregivers or do something else. And the premiums cease on that policy because I've now triggered a benefit. Let's say that I receive that $10,000 a month for 10 months and then I pass away. Well, the original amount of the life insurance was $500,000. I received $100,000 of long-term care benefits, which was advancing part of the death benefit. So we take the 500 minus 100. So my beneficiaries will receive around $400,000 of death benefits, because there may be a few liquidation charges and things in there, but the bulk of the life insurance stays intact. So that's the second scenario that could happen with this policy. Well, what's the third scenario? The third scenario is I have the same $500,000 policy. I am receiving 2% or $10,000 a month, and I use it for 50 months. I have exhausted the full $500,000 of life insurance that ended up being advanced to pay for my long-term care. In those situations, most of the policies have a provision that they will pay a nominal benefit. Usually it's, $20,000 or something in that area that would basically allow a family to bury a person. And we have exhausted those particular ones. So I find that long-term care is a very good thing to have. I'm a little concerned with the trends I've been seeing where on average, the premiums are going up 15 to 20%. They may not do it every year, but they may save it up for 2 or 3 years to go in and get the insurance, the state insurance departments to approve, the increase. The largest 1-year increase I saw with one of my clients was 88% increase in premium in 1 year. My concern with that going into budgeting issues before and after retirement is with the long-term care policies. If the trend continues of a 15 to 20% increase, then within 10 years, the amount you're going to owe has doubled in premiums. And another 10 years, it will double again. And if you are on a fixed income going into retirement, this can be very difficult to absorb, or we're going to liquidate assets. Generally, when I'm going with the life insurance chassis and putting the long-term care riders on it, in those situations, we have a level premium over all years. And so it's a very easy long-term budget item for us to be able to look at. In addition, the life insurance, we may need the lump sum to replace a lost pension or replace lost Social Security income. What many of you don't really think about when you think about preserving the value of the estate, one of your assets that automatically disappears at your death is a Social Security benefit if you're receiving those. I have a lot of couples when they retire, they are counting on both spouses' Social Security checks. And I call it the big check and the little check. Somebody gets more. I don't care if it's $1 more, somebody gets more. Well, when I lose a spouse into retirement, if the person that died was a person that gets a little check, well, the big check still remains the same amount, but that little check income has left the household and the expenses did not decrease with it. Now, if the person who passed away was the person with the bigger check, then what happens is the person with the littler check gets a raise to bring them up to that level. But in either scenario, we're basically losing that income from the smaller amount of the Social Security. Now, if your Social Security was $25,000 a year that has suddenly come out of the household, which could be devastating for some spouses, in 10 years, that's $250,000 of lost income that's not coming in the house. So we can have life insurance for a variety of purposes. And I don't believe, and I don't preach the myth that you do not need life insurance after you retire. It depends. Do we rely on the Social Security income for both spouses? Some of you elect a pension to get the fuller benefit, and so that at your death, it will not continue for a spouse, which could be a double whammy. And to make it just a little more painful, I usually get to tell the spouses, well, unfortunately, now you are a single taxpayer and the tax rates are higher on your income than what you had as a married person. So a lot of dynamics that can come in with life insurance. You know what? You're watching this now. This is a digital asset for me. Many of you have digital assets. What type of estate planning do you have for your digital assets? Think about it. We've got Facebook accounts, Instagram accounts. We've got LinkedIn accounts. We've got YouTube channels. We've got online businesses. We've got TikTok. We have an eBay store, Etsy store. There are so many different things. You have a Pinterest account. These are all digital assets. And some of you add to that by having cryptocurrency and digital coins and those type of things. Have you put that into your estate plan? Do you have domain names that you own? A website? There are so many things that fall underneath this digital category. Now, with some of those providers, they have mechanisms that at your death, you could authorize somebody else to step in and to manage your account or to take the account down. They are allowing you to use their platform, but you don't own that. So, for example, we've all had friends who had wonderful Facebook accounts and they passed away. Nobody had the authority to go in and close down that account. That account is going to be there forever. Whether that's a good thing or a bad thing, that person can be cloned, which nobody likes, but it happens. And so what about your digital assets? Do you even thought about those? And again, I go back to some of our younger individuals. They have got estates already in digital assets. Your pension can be an estate asset because it depends on if you have set up your pension to be able to pay a residual benefit to your spouse or another named beneficiary. I don't see this very often, but I've seen a few pensions that you had the ability to name a beneficiary for your pension, and it did not need to be your spouse. So you could name a beneficiary that was a son, a daughter, or that autistic granddaughter. It depends on what the circumstances were, but that was rather unique. Is that available to you? I don't know, but you have to make these elections before you start pulling that pension income. And you're going to have options, and you need to talk to a financial consultant, a financial advisor. What's best? Should you take 100% pension with no survivor benefits? Should you take a joint and survivor pension for 50%, 2/3, 75%, 100%? You have a lot of different options that are available to you in that particular scenario. What's another thing that we can do? I see individuals that in their estates, they have put language to where they want to leave a charitable legacy, and they're doing that through the probate process. And I'm not a real fan of that because of the way that it can work out that really wasn't the way that you intended for things to work out. So we're going to talk about a couple of different strategies here. Now, if I wanted to leave a charitable legacy to my church and I put it into my will as part of probate, and I said that I want $50,000 to go to, my church, that is now a liability of the estate. So when you're looking at the assets and needing to honor what has been requested, along with the bills, we need to take $50,000, and that needs to be set aside to go to the church because that was one of the instructions that you had left for that executor. What if that ends up taking the money because you had spent down your estate, and now after that's been paid, there's only $47 each for your children? May not have been what you had in mind, but that's the way that it worked out. So a couple of examples that we were able to do with life insurance, so we could still protect the heirs and the desire to pass a legacy that way, but then leave a charitable legacy for your chosen church or charity that that you prefer to send money to. So let's talk about number one. Number one, gentleman, 67 years old. He is not a smoker. He had his wife. She was in her early 60s. And they decided that they wanted to take a percentage of their estate now, one time only, and put it into a life insurance contract that would pay a death benefit at the time that the second spouse passed away. They put in about $37,000 one time. And with that $37,000, we ended up having that as a donation to the church. So there was a deduction on the tax return. We had the policy set up so that the church owned it, and while they were under no obligation to put the money into the policy, they chose to do so. They had a $37,000 donation on the tax return. The money was given to the church and a little more than that, and the church that owned the policy was under no obligation to put that $37,000 in the policy. But they agreed with the concept. It made sense, and it was going to make a larger legacy later because this was over and above what this couple was tithing. By giving that one-time $37,000 gift, when the second spouse passes away, there will be a minimum of a $250,000 life insurance benefit paid to the church, and not a dime will come out of the estate at that point. It is still left intact for their kids. So we turned $37,000 into $250,000 or more, and an income tax deduction, and we didn't take anything away from the kids in the future to do it. Nor, if the couple needed to use some of their resources for long-term care or anything else, the legacy that they wanted to leave to the church, it was still intact. We have another scenario. Maybe it was your desire. You've got money sitting over here in the account. All right, we got $200,000 because we want each one of our 4 children to get $50,000 each. That's the number we want, so we're not going to spend that money in that account. Well, that's one plan that you could do. Another plan might be to pick up a life insurance policy that would pay each one of the children $50,000. It's paid for with a single premium, and then that $200,000 that you had set aside, now you can do something with it, whatever that is, whether that is spend it, create a new income stream off of it, but it gives you the ability to utilize that asset because we've already taken care of what your goal was, which was to have at least a $50,000 inheritance for your children. So that's another way we might be able to use that particular thing. Now, the other thing you may have is appreciated property. You need to have a consultation with your tax person to see if it makes sense to sell that asset and to pass out some of the proceeds earlier, or to restructure it, or to multiply it, or whatever the case may be. Some of you have held on to assets for a long time, and let me give you a little hint. Houses, rental properties, cars, collections, they don't like you. They don't care about you. They can never love you. Now, you can love them and like them, and you can care for them, and you can insure them, and you can clean them and polish them, and you can do all these things. But those assets, they don't care. If you took your house and you sold it to someone else tomorrow and handed over the keys, you're not going to hear one weeping wail out of the house. It doesn't care who puts the key in the lock. So if you're hanging on to some things for sentimental value, well, I love that, or I've had that for so long, that may not be in your best estate interest to do that. Let's talk to some professionals and see what makes the most sense for your situation. Now, I know we've covered a lot of ground here at this point, but I want to thank you for sticking it out all the way to the end. Now, if this was helpful, click the like button, put some comments down. We'd love to see some of your comments. And if you would be so kind, Click the subscribe button. We are adding content on a regular basis, and I do my best to empower you. So click the subscribe button, click the like button, share this on your social media. Thank you so much for coming, and I'll see you on another day.